Hi, I'm Will. In this video, I will be explaining the need for stop loss in forex trading, then talking about some common mistakes about stop loss, and finally Jasmine will explain how to set quality stop loss. Let's get started. Forex trading at its core is about predicting market movement and making a profit when you are correct and eating a loss when you are wrong. Not even the greatest traders can account for every possible market movement, such that it's inevitable for the market to move against you. Being in a losing position is unavoidable. Therefore, it comes down to how we respond. There are two options. Cut your losses and close the trade, or wait until the market moves in your favor again. While the second option has possibility for not only negating your loss, but even generating profit on a losing position, it can also drag you down to a margin call. Live to trade another day is the motto to live by for new traders, because forex trading is not an overnight get rich quick scheme. Instead, it is a complex field involving growing expertise and knowledge over time. So the longer you're able to trade, the more profitable you are likely to be. See, time does equal money. Now that we understand the why of cutting our losses, we need to understand the how. We can just keep our eyes on the market for the entire time it's open. It can't be that long. It's open 24 hours a day. For the sake of our personal life and health, traders need an automated way of exiting a trade once the market has moved against us by a predetermined amount. The answer: stop loss, which can be set as soon as you open a trade. Apart from automatically cutting losses, stop loss can also provide benefits to a trader's mental health by reducing stress and providing a sense of security. So now that we know why stop loss is so important, does that mean we should use it nilly-willy and expect it to always work perfectly? There are many ways that a stop loss can be set wrong. Today we'll cover 3 of them. Number 1 is not knowing the stop loss placement beforehand. Like your entry and take profit, you should know your stop loss beforehand. The reason for this is that it ensures you are able to remain illogical whilst the position is open. Once you start seeing your floating P&L will float, you can come up with any number of reasons to stay in the trade. Or when the market starts to move against you and your floating loss becomes a looming loss, you might chicken out before your forecast made using technical analysis has actually been proven wrong. Number 2 is reliance on magic numbers. Many online guides for newbie traders teach the process of position sizing based on portfolio size. It's easy to understand without needing complex indicators or oscillators. However, many newbie traders either misinterpret or only remember part of this method. The incorrect method of using this process is: based on their portfolio size, traders will pick a position size. Then, based on some kind of rule of thumb percentage, which limits how much of the percentage they can lose on a single trade, which is converted into pips, they set their stop loss. At first glance, this seems reasonable and very mathematical. But the problem is, this just gives you a magical number, and the market does not care about those. Instead, position sizing involves first locating a stop loss level, which if reached, proved that your entry based on technical analysis was incorrect. Then, through the pips difference between the entry and stop loss, find an appropriate sizing based on max percentage of portfolio at risk, with some potential adjustments based on likelihood of your prediction being wrong. The 2 approaches follow a similar logic but an almost inverted process, thus showing how it is an easy mistake to make. The last common mistake covered in this video is having a too wide or too loose stop loss gap. Too wide stop loss placement is fairly intuitive in how it's problematic, as it can involve traders being too optimistic. However, there are also some less obvious issues. Firstly, a position that is at a loss but has a large stop loss gap would take a long time before it is stopped out, or even longer for the trade to be profitable again. Therefore, the funds used are locked up, instead of being used in a more reasonable trade, with narrower stop loss. Another issue is that logically, stop loss should be closer to entry than take profit, as you want less risk for more reward. Therefore, a really large stop loss cap means an even larger take profit, which can be very difficult to predict correctly. Stop losses that are too tight are problematic as they can be easily knocked off, especially if traders don't take into account the general volatility of the market. For example, the Euro USD pair has 10-week average for daily movement of 43 pips. Once again, coming back to the purpose of using stop loss, which is for it to protect traders when they made an error in judgment, not to insulate them from normal market movements. Whilst the advice given in this common mistake is unlikely to apply to more experienced traders because they can be removed through experience and quality technical analysis, it will still be very helpful for newbie traders to keep them in mind. Now we'll go on to Jasmine, who will teach us how to properly set stop loss using the ATR method.
Now that Will has taught us more about the fundamentals of stop losses, I'll be going through where to set a stop loss to effectively minimize the chances of getting stopped out. With trading, as we already know, there will inevitably be losses, and our job is to minimize them. What skilled traders do is that they have their own money management plan within their individual trading strategy, which has been backtested to show that their losses are small compared to their profits. There are many ways to do this, and one way is to use the ATR indicator, which stands for Average True Range. Basically, the indicator tells you how many pips the currency pair has moved on average over a certain number of previous candles. Essentially, this indicator changes according to market conditions, meaning that the value of the ATR for one currency may be different for another. Because of its ability to adapt to such conditions, makes it a valuable indicator to consider when setting a stop loss because it is based on recent data. And also, it is one of the many ways to help minimize getting stopped out. When you pull up the ATR indicator on your trading platform, you'll see that there are 5 decimal places. To calculate how many pips the currency pair is fluctuating by, you just move the decimal point 4 places to the right. So just 1, 2, 3, 4. As you can see here, this value translates to 8.9 pips, or you can just round it up to 9 pips. This means that the price is fluctuating at around 9 pips on average. On this slide, we are now going to go through how to apply the ATR indicator. For long trades, we'd want to identify the most recent lowest low and then subtract 2 times the ATR, just like this shown in the diagram here to the right. So as you can see, this is the recent lowest low, not this one, and then there is the stop loss here, and the distance between the stop loss and the lowest low is 2 times the ATR. And then for short trades, we identify the recent highest high and add 2 times the ATR to get the stop loss level as shown here to the right. So basically this is the highest high, not this one, and then there's a stop loss, and to get this stop loss you just add 2 times the ATR to this value. Alright, so now that you know what the ATR indicator is, I'm going to show you how to add that to your trading platform. Right now I have the MT4 trading platform in front of me, but you should be able to do it on any other trading platform such as TradingView. So for MT4, you just click on Insert, Indicators, Average True Range. These settings are fine, so just click OK. And there you have it. This is the ATR indicator as illustrated by this line. The trend of this line isn't important, but what is important is this number over here. Right now it is currently reading 0.00084, which means that the price is fluctuating at around 8.4 pips. Now that we have the ATR indicator in our trading platform, I'm going to show you an example on how to use the ATR indicator to properly place a stop loss. So let me just zoom out and find an example. Alright. So as you can see here, I'm looking at the Euro USD chart on the 15-minute time frame. You can see that there is a strong level of support here, and then the price goes up and the price goes down. Now for amateur traders, as soon as they see these 3 consecutive bullish pin bar candles at around this zone of support, they are anticipating that the price will reverse and go back up. However, they will place the stop loss at the low of this pin bar candle. So let me just show you what they'll do. So just go to insert object horizontal line. So normally amateur traders would place their stop loss at the low of this candle. And as you can see, the following candle dips below the stop loss line and the trader gets stopped out. And that's a shame, because as you can see, the price actually moves up, and still to this day, at the point of recording this video, is still going up. So in order to not get stopped out, it is important to have a strategy in place. Today I'm going to show you how to use this ATR indicator to help you position your stop loss level. So one way is to take this, take the value at the low of this candle and minus 2 times the ATR. At this point in time, the ATR was around 0.00055, so we can just round that up to 6 pips. And if I do that on the calculator, the new stop loss level would be 1258 minus 2 times 6, which is 12. That should be at 1246. So the new stop loss level should be at 1246. Let me just change it. And there we have it. By using this stop loss level, the position doesn't get stopped out, and you'd be able to ride this trend. And that's it for this example. So this example just shows you how important it is to have a strategy on where to set your stop loss and not just randomly place it at a low. That is what many amateur traders do, and they get stopped out early and they miss many very good trading opportunities. And that brings us to the end of this video. I hope you guys enjoyed and learned something. Thanks for watching. Bye.